Let's dive into the world of stock splits. Now, I know what you might be thinking. Stock splits? Sounds complicated, but fear not. We're going to break it down into bite-sized pieces, making it as easy as pie. So what exactly is a stock split? Simply put, a stock split is when a company divides its existing shares into multiple new shares. This doesn't change the overall value of the company. It just increases the number of shares available while reducing the price per share. Imagine you have a delicious chocolate cake. If you cut it into smaller pieces, you still have the same amount of cake, just in more manageable slices. That's a stock split for you. Now let's talk about how it works. When a company decides to split its stock, it usually announces a split ratio. This is the magic number that tells you how many new shares you'll get for each share you own. For example, in a 2-for-1 split, if you own 1 share before the split, you'll end up with 2 shares after. But here's the kicker: the price per share will be halved. So if the stock was trading at $100 before the split, it will be around $50 after. Your investment value remains the same, but you now have more shares to play with. It's like getting 2 tickets to a concert instead of 1, but the total cost remains the same. Now, you might wonder how a stock split affects the stock itself. Generally, a stock split can have a positive impact on the stock price in the long run. Why? Well, when shares are more affordable, it can attract more investors. Think about it. If a stock is priced at $1,000 per share, it might scare off potential investors who don't have that kind of cash lying around. But if that same stock splits and becomes $500, it suddenly feels more accessible. More investors can jump on board, which can lead to increased demand and ultimately a higher stock price over time. It's a bit like a popular restaurant. When the prices are reasonable, more people want to eat there, and the buzz just keeps growing. Now let's explore the different types of stock splits. The most common one is the forward stock split, which we've already touched on. But there's also something called a reverse stock split. This is when a company consolidates its shares, reducing the number of outstanding shares while increasing the price per share. For instance, in a 1-for-10 reverse split, if you had 10 shares at $1 each, you'd end up with 1 share valued at $10. Companies usually do this to boost their stock price, often to meet listing requirements on stock exchanges, or to make their shares look more appealing to investors. It's like taking a small, scruffy dog and giving it a stylish haircut. It just looks more presentable. So, why do companies decide to go through the process of a stock split? There are several reasons. One of the most common reasons is to enhance liquidity. When a stock is more affordable, it attracts a broader range of investors, which can lead to increased trading volume. More liquidity means that it's easier to buy and sell shares without significantly impacting the stock price. It's like having a busy marketplace where everyone wants to buy and sell. The more bustling it is, the better for everyone involved. Another reason for a stock split is to signal confidence in the company's future. When a company splits its stock, it often indicates that management believes the stock price will continue to rise. It's a way of saying, hey, we're doing well, and we expect to keep doing well. This can boost investor sentiment and attract more buyers, creating a positive feedback loop that can drive the stock price even higher. Additionally, companies may opt for a stock split to make their shares more appealing to institutional investors. Many large investment firms have policies that prevent them from buying stocks priced above a certain threshold. By splitting the stock and lowering the price, companies can open the door to a whole new pool of potential investors. It's like throwing a big party and inviting everyone. The more, the merrier. Now, let's not forget about the psychological aspect of stock splits. Investors often perceive lower-priced shares as a bargain, even if the underlying value hasn't changed. This can create a sense of excitement and urgency, leading to increased buying activity. It's a bit like seeing a sale sign in a store. Even if you didn't plan on buying anything, you might just snag a deal because it feels like a good opportunity. However, it's essential to remember that stock splits don't fundamentally change a company's financial health. They don't create value out of thin air. The underlying business performance, market conditions, and overall economic environment still play a significant role in determining a stock's long-term success. So, while a stock split can be a positive event, it's crucial to look beyond the split and evaluate the company's fundamentals. In conclusion, stock splits are a fascinating aspect of the investing world that can seem daunting at first, but once you understand the basics, they become much more approachable. A stock split increases the number of shares while lowering the price per share, making it more accessible to a broader range of investors. Whether it's a forward split or a reverse split, companies have various reasons for choosing this route, from enhancing liquidity to signaling confidence in their future. So the next time you hear about a stock split, remember, it's just a way for companies to slice their cake into more manageable pieces, making it easier for everyone to enjoy. Happy investing.